Vanguard ETFs are some of the best investments that you can make on the stock market. So, in today's video, I'll be going over the 5 best Vanguard ETFs that you can buy right now and hold forever if you're looking for some great diversification as well as some tremendous potential of growth over the next couple of years. Starting with my first pick, which is the Vanguard High Yield Dividend Index ETF with the ticker VYM. This ETF is simply tracking an index composed of high dividend yield companies. If you're looking to earn more passive income as well as more dividend income in your investment strategy, this ETF is definitely a must for you. With a dividend yield of about 3%, VYM has been giving consistently a great quarterly distribution to its holders. And by buying this ETF, you're buying a total of 440 different stocks, which include companies such as Johnson & Johnson, ExxonMobil, JP Morgan, Chevron, and Home Depot as some of its biggest holdings. And in terms of the sectoral distribution, we can see that the financial sector comes at the first place, followed by the healthcare, the consumer staples, the energy, and the industrial sectors. And for a super low management fee of only 0.06% per year, you can expect to pay about $6 per $10,000 invest. 10 years ago, if you would have invested about $10,000 in that fund, this would currently worth slightly over $30,000, which represents a great average annualized return of about 11.60% per year. This fund is also super interesting in high inflationary times since it is providing some great and some high dividend companies in it, and with the dividend income that you could receive from it, this could come offset the big losses that many companies are facing throughout recessionary times. But obviously the risk versus reward quotation is about 4, meaning that there is still a risk when you're investing in that kind of ETF, but there is still a great potential of growth in the future. The second Vanguard ETF that you must own in your portfolio is a no-brainer, and it's the Vanguard S&P 500 ETF with the ticker VOO. This fund is tracking the famous S&P 500, which is an index that is tracking the 500 largest companies in the United States in terms of valuation. The big advantage of this kind of ETF is that it is a perfect mix between some high growth companies as well as some high dividend companies. It is why among the 506 stocks within this ETF, you can find companies such as Apple, Microsoft, Amazon, Berkshire Hathaway, and Alphabet among its biggest holdings. And with no surprise, the technology sector comes at the first position with about 26% of the total assets in this ETF. After, you can find the sectors of the healthcare, the financials, and the consumer discretionary. Over the last 10 years, with your initial investment of $10,000, this would currently be worth about $34,000 at the moment. This represents an incredible average annual return of about 12.52% per year. On your part, by holding this ETF, you can expect to pay some management fees of about 0.03% per year, or if you prefer, $3 per $10,000 invest in that fund. And this ETF is also giving some great quarterly distributions. So as you can see, this ETF doesn't have some big cons to it because it is pretty much one of the best ETF that you can find on the market right now. However, just like for VYM, this ETF also have a pretty high risk versus reward quotation of about 4, which is showing that you must be willing to take a little bit more risk to receive a potential higher growth in the future. And with this high volatility, it is notably why we've seen that over the last year, this ETF has been down of close to 20%. But if you're someone that wants more stability and less risk in your portfolio and that is also willing to have less potential of growth in the future, well, you could go with the Vanguard Short-Term Inflation Protect Securities ETF with the ticker VTIP. This ETF is quite special since it is tracking an index composed of inflationary protect US Treasury bonds, with the particularity that these bonds have a maturity of less than 5 years. It is pretty interesting since usually we are using the maturity of a bond to calculate what is its current risk, and obviously the longest the maturity is, the more risk there is, and vice versa. Because in fact, the longest you have to wait until your bond comes to an end, well, the more chances you have that the interest rates will fluctuate. And usually when the interest rate in general are increasing, it means that the price of bonds will decrease. And right now we are in some times where the interest rate is pretty high, meaning that the price of bonds is super low. So there might be a great opportunity on that side. By buying this ETF, you are buying about 22 bonds with an average effective maturity of about 2.4 years. And with the small duration of this ETF, it has the power to reduce a lot the risk versus reward quotation of only 1 star. And what is also pretty interesting is that the yield to maturity, which is representing the average return that an investor could expect to earn if he was holding the bond until its maturity. So after 2.4 years, he could expect to earn about 4.2% of return. So as I told you, the recent rise of the interest rates has made this kind of ETF pretty interesting at the moment. And in terms of the composition of the bonds within this ETF, you can find that the majority of them is coming from the US government. And in terms of the maturity of them, we can see that they have a pretty equivalent ponderation with about 20% from 1 to 5 years. And on their part, they are also giving some great quarterly income distribution, which are coming from the coupon payments of the bonds, which are pretty much the same as the dividends for the stocks. On your side, by buying this ETF, you could expect to pay some annual management fees of about 0.04%, or if you prefer, only about $4 per $10,000 invest in that fund. And 10 years ago, with your initial $10,000 investment, this would currently be worth slightly over $11,500 at the moment, which represents a pretty low average annual return of about 1.30%. So obviously the big pros of this kind of ETF is that it comes diversify your overall portfolio, which must have already a lot of stocks, and it also comes to reduce the risk of your portfolio. And it also adds some direct exposure to the fluctuation of the interest rates. But unfortunately, judging by its past return, we can see that it isn't the best ETF if you want to get rich quick, but it would be more a great ETF for you if, for example, you want to preserve your liquidity. However, if you're willing to take a little bit more risk and have a lot more potential of growth, well, you could be looking at the Vanguard Total International Stock ETF with the ticker VXUS. This fund is tracking an index composed of companies that are located in emerging as well as in developed markets that, however, exclude the United States. It is why over the 7,877 stocks within this fund, you can find companies such as Taiwan Semiconductor, Nestle, Tencent, and Roche among its biggest holdings. In terms of the sectoral distribution, we can see that the financial sector comes at the first position, closely followed by the industrials, the consumer discretionary, the technology, and the healthcare. Over the last 10 years, your initial $10,000 would be worth nowadays about $16,000. And this represents an average annual return over the last 10 years of about 4.08%. As you can see, they've been able to achieve some pretty fair return, but what is the big advantage of this kind of ETF is that it is giving you some great geographical diversification, and on your side, you don't even have to take too much risk when you're buying this ETF, as we can see with the risk versus reward quotation of about 3 stars. Plus, you can expect to pay some management fees per year of about 0.07%, representing about $7 per $10,000 invest, and you would also receive some great quarterly distributions from this fund. And finally, for my last pick, I've went with the Vanguard Real Estate ETF with the ticker VNQ. This ETF is tracking an index composed of real estate investment trust companies, also known as REITs. Those are basically businesses that are buying different office buildings, hotels, and other different kind of real estate properties. If you're looking to invest in real estate without having to put too much money up front and without having to deal with all the problems that could come with it, such as the tenants and the mortgage, well, this option could be a perfect alternative for you. Plus, real estate is also considered as a great hedge against the inflation, which could be particularly interesting at the moment. By buying this ETF, you're buying 167 stocks, which include companies such such as Prologis, American Tower, Public Storage, and Realty Income among its biggest holdings. We can also notice that the majority of these companies are in the category of the specialized REITs, followed by the residential REITs, the retail REITs, and the industrial REITs. With $10,000 invested 10 years ago, this would currently be worth close to $20,000 at the moment. And this represents a pretty good average annual return of about 6.41% over the last 10 years. And for a slightly higher risk versus reward quotation of about 4 stars, you can expect to pay some annual management fees of about 0.12%, or if you prefer, $12 per $10,000 invest. And under part, VNQ is also paying some quarterly distributions. Now that you find what are the best Vanguard ETFs that you can buy at any time and hold forever, you might be wondering, hey, but Louis, which ETFs would you recommend me to check out if I want to receive some great monthly income from them? Well, in that case, check out the video that's gonna be right over here, and I will see you soon. Peace!